Hey, good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, January the 28th, 2026. Pretty big day today. We obviously have sort of earnings and whatnot. We'll get onto that in a second. And we have the FOMC. I'm going to do a separate FOMC sort of preview probably after this, so I'll release that in an hour or two. In the meantime, let's just focus on what's been going on. Obviously, the big moves is basically in the FX space and also in the precious metal space. As I say, in the separate video, I'll talk about the Fed a little bit later. Just a quick recap. We know that Trump yesterday afternoon, just a couple of tweets here. Trump isn't concerned about the decline in the dollar. We know he also said Trump dollar is doing great. He also said the dollar is seeking its own level, which is fair. And just another little tweet here, Trump doesn't think dollar declined too much. So the point here is that Trump's comments were essentially interpreted by the market as saying that the administration, perhaps even in a tacit way, in a non-sort of open way, is okay. It's acceptable for them to have a sort of a weaker dollar, which is going to, of course, make American exports a little bit more competitive. On the other hand, that could create a little bit of a problem for the Fed because at the margin, that means that imported goods and imported services, but mainly imported goods, would be a little bit more expensive, which has sort of inflationary impacts, which of course could impact, not only inflation, but of course bond yields and basically what the Fed is trying to do. So let's have a quick look here at the dollar here. And it's just interesting if you look at the spot price changes versus the dollar since January the 20th, 2025, which is basically since Trump got in. And you can see here, just this snapshot gives you a big picture. So we see here the Swedish krona doing very well. And really what we're seeing with these different performances of different FXs are probably the two major forces driving the FX markets at the moment. So one is this idea of fiscal responsibility, this idea that the US and certain other sort of currencies or countries they're not fiscally responsible. They're issuing too much debt. They're doing too much stimulus. Their debt to GDP ratio is too big. So a lack of fiscal responsibility. And, at the margin, in the case of the US, a lack of sort of central bank independence. The second question is really this idea that in an environment where there's sticky inflation, a lack of fiscal sort of a discipline, and sort of overly stimulative sort of policies and sticky inflation, I think maybe I just mentioned that, then currencies which are doing well are currencies which are perceived to have independent central bankers, but also sort of real assets like sort of commodities. So what we're seeing here is a classic case of the Swedish krona, which has a very independent central bank, but it has a very good fiscal situation, very low debt to GDP ratio, and a pretty strong manufacturing base as well. And you see the Swedish krona is doing super, super well. Now, obviously, in that same kind of basket of fiscal responsibility, low debt, low inflation, independent central banks, you're seeing the Swiss franc is doing very well. It's also a bit of a safe haven. You see the Norwegian krona doing very well. And what's interesting is that the currencies which have done quite well, but not quite as well as these guys. You see now the sort of the Mexican peso, which is part of the emerging market story. So a lot of sort of Chinese manufacturing going there, and also sort of higher interest rates, which is part of the carry trade. And then you look at things like the South African rand and the Brazilian real. These are really which have done well. These are really part of the commodities situation. So obviously you've got the rand with gold, you've got the Brazilian real with all kinds of commodities, and then you've got currencies which have done relatively well. Like the Aussie dollar has also done quite well. Again, it's shielded from geopolitical dramas, has a good fiscal situation, independent central bank, and obviously has a lot of commodities. So the one which hasn't done so well is the Canadian dollar, which obviously its economy has ties, is very closely interlinked with the US economy. And then the Japanese yen, which was spoken about a lot. They have a huge debt to GDP ratio, about 240 or 250%. They don't have commodities. They need to import commodities. And the central bank there is potentially, very closely allied to the government and is potentially a little bit behind the curve in the sense that perhaps they ought to have hiked a little more aggressively. So very interesting chart there showing us what's going on. And then just want to have another quick look to see where we're at with the dollar. So this is not the dollar index, the DXY, the Dixie, which, as I say, doesn't have a lot of emerging market currencies and doesn't have the Chinese currency. So I've got the Bloomberg index here, which is a much broader index. And you can see that we're at levels we haven't really been at for, 4 or 5 years, going back to 2022, 2021 levels. So the dollar here is at a critical point. So let's just go through and have a little bit more of a look at some of these things as well. So if we look at a few charts here, again, I will go back to the well, before we go into the dollar and that, I want to look a little bit just at this general idea of sort of global assets and US assets. Now, keep in mind that if we look at sort of asset managers and sort of, the big funds in the US, excuse me, doing a bit of research, there's only about 11% of assets are held outside the US. So only 11% of assets are global. And that's a lot less than it was, let's say 10 or 15 years ago. So as we know, there's been a very strong sort of narrative in the last 10 years of there is no alternative. You've got to be in US assets, overweight, US stock market, et cetera, et cetera. But we're definitely seeing some kind of turning of that. And, part of that is this idea that, if there is going to be sort of a Mar-a-Lago Accord, and the Trump administration, on a deep sense, does want sort of a slightly weaker dollar, and these kind of things. Maybe the idea of being overweight in U.S. assets is no longer desirable. And so, just to get a sense of that, we could see something like here the ACWI, which is basically the totality of kind of sort of, it's kind of like a global stock market ETF, if you want. Now, has it been doing super well? Yeah, absolutely. You can say it's been doing super well. And let's just put it, let's say year to date. Yeah, do we have that there? So if you say year to date, and obviously after the Liberation Day tariffs announcement, has that been doing very well? Yes, it has. So no complaints there. It's not that the US stock market is not doing well. Now, if we put on a similar thing, which is the ACWX, which basically excludes the US, has that been doing very well? Yes, it has. You go, okay, so what point are you trying to make, Angus? But when you actually compare the two, which is this next chart here, look at that, you see that actually, if you look at the all world divided by excluding US, you can see how negative that's going. And that's basically saying that the rest of the world is outperforming the US stock market on a very broad sense here. So you see here that it's really starting to US is underperforming. And if we look at a few ratios, again, we can look at, let's say, SPY versus VEA, similar kind of situation there. Again, I've shown you SPY versus emerging markets, SPY underperforming. If you want to look at emerging, let's say SPY versus Japan, that's an interesting one. That's a bit flatter because we know the problems in Japan. But let's say, for example, emerging markets excluding China, you can see how strongly that's going. So the point here is that there's definitely, within the US, there's all kinds of rotations between, the tech and the semiconductors, small caps have talked about that. But globally, there's definitely that 11% of foreign assets currently held by US fund managers and sort of asset allocators. I do believe that 11% will probably gradually go up to 12, 13, 14, 15%. And that's part of the sort of US dollar weakness as well. Definitely money is going to places like Brazil. We've looked at, let's say, the EWZ, which is the Brazilian, the basic ETF there. You see that's going very, very high. You see something like the US dollar versus Brazilian real, very weak. The point here is that if we look at, let's say, Mexico, you can see the Mexican index doing very, very well. We see the US dollar against the Mexican peso is underperforming big time. Part of that's the carry trade. But so the point is here is that, it's all about long assets, which are sort of real assets, and that's perceived to be sort of gold and silver, sort of copper doing pretty well. Oil is not collapsing as much as it could do. And we're seeing that a lot of money is going into these sort of so-called commodity kind of sort of countries, which are doing very well, and more broadly going into Europe and into Japan and some of those other sort of developed markets, like Australia is doing well, New Zealand, these kind of countries doing very well. So that's really sort of a big sort of one of the big flows. Okay, so if we just go back now into just some more sort of the traditional markets, let's have a quick look at vol. We can see that the VIX is, it's creeping up. It's not, the last couple of weeks it's not at 13 or 12 handles, so it has crept up a little bit. Up to about 16 or so, and we'll talk about that more when I talk about the Fed. But really, the ones I want to be looking at is always also the MOVE index. Again, very, very low. In general, with the low volatility for the bonds, that is a positive. That's a tailwind for the equity market. Obviously, we're seeing in the precious metals. Sorry, I'll go to gold here. You see very elevated levels of volatility in gold, and of course, in our dear friend silver, you're seeing all kinds of elevated volatility. So, what's going to be the effect of that? Effectively, we're seeing that, for example, in the Shanghai Exchange and yesterday in the US and the CME, they both increased margins. So now margins in the CME are 11% of notional. So what that's doing at that's not going to be a huge issue for institutions, but for the smaller players, that means things like gold and silver. They're going to slowly be squeezed by these increased margins, and with the increased volatility, that will generally force most players to sort of slowly deleverage, and sort of reduce their positions. Okay, so let's look at obviously the go back to the dollar index. Now, you can see here that it broke down through some key levels here. I was indicating that this was a key level. And after Trump's tweets had busted down through there, we've had a little bit of a rebound this morning, and all across the board, the US dollar has rebounded. So really, it's going to come down to probably the FOMC. Now, the thing is that the data in the US is still quite good. We had durable goods yesterday, which was relatively strong. We have initial jobless claims tomorrow. The labor market seems to be good. The employment market seems to be good. I suspect that, very briefly, that the FOMC today, Powell will be, I'm not saying it's going to be a sort of a super hawk, but I think there's no justification for him for being dovish at all. Inflation is clearly not collapsing, at least in the US. The data, such as we have it, seems to be relatively good. And of course, in the elephant in the room is the whole political situation. And Powell most probably will not be on any sort of. There's no need for him to sort of wax lyrical about having lower interest rates. So the point is that there could be a little bit of hawkishness coming out of the FOMC. At the minimum, some neutrality. So could we get a little bit of bounce in the US dollar? Yes. So really, what's going to be important is to see what happens in Thursday, Friday, Monday. Will the US dollar, even if it sort of gets back to these levels, will it then have another leg down? Now, can it have another leg down? Absolutely. If we actually look at this on, let's say, a monthly chart, really to zoom out here a little bit, just for some perspective, you can see that the US dollar, for sure, it's come off its highs of, let's say, 2023, 2024. But just on a slightly, more zoomed out level here, we can see that the US dollar has room to go down, let's say, to 94 and a half, and then down to 91, and even, let's say, down to 88. So, and that can happen relatively quickly, as you can see. So even a move like that is not, crazy. That's another 8 or 9%. Is that possible? I think we'd have to say absolutely it is. Now, you can also see here just on the monthly, we're at a 200-month exponential moving average here. So pretty key levels. And can the US dollar go down more? I think we'd have to say absolutely that's possible. And again, if that's the case, that's, as I said, that's going to potentially put a little bit of inflationary pressure back in the US. But if we just let's go back to the dailies here and look at some of the other currencies. So I want to talk about the euro briefly. Euro obviously busting higher. Broke above this pretty key level at 119. Could that go a bit higher? Yes, it could, obviously. But what's interesting today, by the way, keep an eye out for Schnabel, who is speaking. She's one of the, excuse me, little sip of tea. We have Schnabel speaking at 1 p.m. She's one of the sort of more intellectually enlightened members of the governing council, and quite a sort of important and influential. Let's see if Schnabel is sort of hawkish, dovish, neutral. There's been a lot of talks about neutrality at the ECB. But in terms of Europe, what is interesting is that as these currencies like the euro and the Swiss franc, and we saw the Swedish krona, although it's not really part of the ECB, but as we're getting these stronger currencies in Europe, that is going to be sort of deflationary for imported goods. So all of imported goods are, often priced lower, which is going to be deflationary. So could we start to see some downside risk, not upside risk, but some downside risk for inflation in the Eurozone? So think about what's happening. We might be getting some downside risk to inflation in the Eurozone and some upside, or these sticky inflation in the US. That could be sort of interest rate differentials here, which again would be a positive for the euro. So, any kind of decent retracement here, again, probably the thing to be doing is some kind of retracement back to the 119.15 level, something like about that. Or you could easily just throw on a quick fib, which I'll put here, and I'll probably anchor that on the 19th of January. That's a good one there. And as you can see, the 38% fib retracement, there's an interesting level potentially for a long at the 118.60 level, which is just below that horizontal resistance there. So anywhere in there, 119.20 to just a little bit below, that represents the 38% fib. That would be an interesting potential sort of re-entry level for long along the euro. So if we actually then look at the other one I want to look at over in Europe, of course, is the Swiss franc. Now, the Swiss franc, there's talk that you see the market. I mean, the Swiss franc is not only is benefiting from US dollar, but just generally safe haven. It's has fiscal responsibly sort of central bank, well, sorry, a sort of government and a central bank, which is, obviously sort of independent and pretty serious. So you see the Swiss franc here is ripping higher. So where could that go? We have to sort of scroll out. I don't know where that could go. We'll have to look on the monthlies or something. But that is getting very, very strong. And that actually in itself is a problem for the Swiss franc. With the Swiss franc, they have their overnight interest rates are very low. I think it's 25 basis points or so. They don't want to go negative. But if the Swiss franc continues to go on this strengthening path, again, even more so than the euro, that is going to be deflationary for any imported goods because that obviously costs less in the local currency. So it's going to be interesting to see if we get any intervention, any verbal intervention from the Swiss bankers, essentially saying, whoa, whoa, the Swiss franc is too strong. And will they start to sort of actually buy the franc because this is getting maybe a little uncomfortably strong. And you see here, where could this go? I mean, I don't even know if it's a measured move here, but this looks like on a straight sort of a downtrend for the US dollar. So that's a very interesting one to be looking out for there. And just in talking about that, if that's the case in Europe, just have a quick look here at the bonds at the front end of the curve. So this is the Schatz. So where's my Schatz? So if you look at the Schatz here, which is the 2-year bond in Germany, you can see that indeed over the last 2 or 3 days, and yesterday had a big boost, maybe on this idea that, hey, the US inflation rate is sort of, a little bit sticky. The Fed may be cutting, especially if they get Rick Ryder coming in unnecessarily, and that's not great. So maybe, this slightly sort of deflationary impulse in Europe is going to be good for the front end of the curve. So you see here the 2-year Schatz going up. We can see here the Bobble also having a nice strong day yesterday. And then if we look at the Bund, less so, and then we look at the back end of the curve, the Buxel. So look at the Buxel, the 30-year here. It did move up yesterday, but not much at all compared to, let's say, the Schatz at the front end of the curve. So what we're getting there is obviously sort of a steepener, so a bull steepener. So the front end yields going down a lot more compared to the back end yields. And that's really telling you that, maybe a deflation is coming and that the ECB needs to be sort of thinking about cutting rather than just staying neutral and even hiking like other parts of the world, but maybe even cutting if deflation comes to town. So let's keep a look on these front end bonds, but also a very careful look on Switzerland. Okay, just looking at another currency which I want to be looking at. Another couple of currencies. We had the Bank of Canada today at 9:40. They changed at what time is that these days? 9:45. We had the Bank of Canada. Then at 10:30 we have Tiff Macklem's press conference. So again, the Canadian dollar is doing well against the US dollar. As you can see here, this USD CAD. So obviously the last, basically in general, if you go back, sort of the end of November, there was a big sort of move lower and then higher. But essentially the Canadian dollar is doing well. But let's look. We're at key levels here. It's kind of a quadruple bottom at about 135. Now, if we look at a measured move here, a Fibonacci extension, let's see where this potentially go. This is a beautiful technical chart here. So if we just do a fib extension, we can see that actually we're getting towards the end of the measured move. This is interesting. So pretty key moment here for the Canadian dollar, because one could argue that the Fibonacci extension we're sort of getting into those territories where it's more or less done, at least from a sort of a classical perspective, and we are coinciding with that sort of horizontal resistance. So the question is, the Bank of Canada has actually sort of cut a lot more than other central banks. And if we actually look here, I've got a chart here which shows some relative, where's that? I think I've got a chart here. Yeah, so you look here at some of the main central banks where they're at, and you can see the Bank of Canada, this turquoise color here. You can see that the Bank of Canada actually is cut more aggressively than any other major sort of central bank, with the exception, let's say, of the New Zealanders, the Kiwis here in the gray. So the Bank of Canada has cut quite aggressively, certainly a lot more than the Fed here, which is kind of the black line, and even the Reserve Bank of Australia, which is the sort of a red line here. So the Bank of Canada probably doesn't want to be cutting anymore. And the data has been mixed at the moment, so it's going to be interesting to see what they do today. They're not expected particularly to cut, obviously, or to hike. So let's keep an eye on that. The other thing which I want to be looking at, the other FX pair, is the Aussie dollar. Now, I pointed out yesterday that was at a key level, that overhead resistance here at about, 69.5 or so. It was like a kind of a triple top. Boom, we can see that it's broken up. Now it broke out on two. So just to put this into perspective, again, we're getting some of these measured moves are starting to get a little over, well, I don't want to say overextended, because from a technical point of view, the full measured move is not until 72 cents, which is still a long way away. But let's definitely watch this level up here, which would be a triple top, which is 71 cents. So why is that happening? Two reasons. Yesterday, obviously, we had the Trump tweets, which was considered by the market to be a bit of a green light for a slightly weaker US dollar. So the Aussie, along with all the other currencies, accelerated. But last night we had the quarterly CPI numbers, and the quarterly CPI numbers, the trimmed mean, which is sort of the preferred measure of the Reserve Bank of Australia, that was actually at, I think, about 3.3%, so higher than expectations, and definitely higher than where the Reserve Bank of Australia wants the inflation rate to be. So if we go back here and just look where the RBA is, as I said, the red one, they're not the most dovish, but certainly not the most hawkish. And basically, the market has started pricing in for their next meeting in February a hike. Not fully priced in, but definitely went up sort of, I think, about 5 or 10 basis points, the possibility of a hike. So we're getting a situation where we could have the Fed cutting maybe in an unjustified way, 2 or 3 times this year. We have maybe the Bank of Japan potentially hiking in the next meeting. We have maybe the Reserve Bank of Australia potentially hiking, and maybe some of those banks which have been a little more dovish in the last year or two, let's say like New Zealand and Canada, just kind of on hold, and maybe the ECB. So we're starting to get quite a lot of divergence on monetary policy, which is shaking up the FX market, and which is great in terms of trading, but also pushing up volatility in some of the currency pairs. So that's quite interesting as well. Okay, guys, I just want to finish off quickly, having a quick look at a couple of the commodities. So let's have a look at where are we? Energy. So oil breaking out. You can see here, as I was saying, it was looking quite bullish on the chart. So it's broken higher to the 62.30 level, which was the key sort of triple top level. Now that's also a lower, weaker dollar is, generally not like the old days, but it's not bad for oil. Of course, a lot of oil contracts around the globe, of course, are priced in US dollars. Having said that, the US is a major oil producer, so it's a lower US dollar and lower oil price is not great for the US oil producers, a lower US dollar. Anyway, but basically, the US dollar is, that's not bad. But really, what we're still getting saber rattling by Trump. He keeps on referring to the huge armada, the naval flotilla, which is steaming. Actually, it's probably nuclear power, but it's, let's say, steaming towards the Middle East and Iran. So the oil market is saying there's a non-negligible chance still of some kind of, I don't know, strike on Iran by the Americans. Who knows? Maybe Trump wants a diversion. So there's still a bit of risk premium in the oil market. But again, I think technically we're starting to get a bit of a short squeeze here. Anyone who's short is probably, having to sort of cover their positions. So we're seeing here this measured move again, the Fibonacci extension that's starting to sort of get towards completion. So this is going to be a very key point here, because you see all the moving averages pushing higher. The CTAs and the momentum funds will start to be sort of piling onto this, especially with this big green candle, maybe even increasing their positions. Let's monitor this position. Sorry, this level here at 62.30. If oil gets back here and holds that, we could definitely be in for a little bit more sort of upside, maybe even testing some of these levels here at about 60, let's call it $65, which is approximately these levels, and it also coincides with the full one level sort of move on the Fibonacci extension. What we are seeing is a little bit of a diminution you see here the Dutch nat gas. You also see in nat gas in the US. So now we've rolled over into, hold on, let me just see here which one we're on here. I have to double check. But basically seeing here that the nat gas is coming off. There's talk that, the winter storms in the US is still around, the cold weather is still around, but a lot of the drawdowns and usage, is starting to be sort of fed into the system. And so that sort of spike because of the bad weather is coming down a little bit. So let's keep an eye on the weather patterns. That's definitely going to be the most important thing there. And then, of course, we have our dear friends, the precious metals, which are, where are my metals? Oh, here we go, metals. Okay, so if you look at spot gold, listen, pretty simple. A debased US dollar, a weakened US dollar, all of that macro stuff, none of that has changed. And what we have to keep in mind here is that, is gold oversold? Maybe, but it's a relatively orderly push upwards. Now, is it oversold? Yes, but there have been a few little retracements here and there. Gold possibly needs to come back up, but it's definitely less volatile than silver. And so for things like, big hedge funds and whatnot, that will make gold on a relative basis a little more attractive because just the volatility is less. But we also have to keep in mind that there is constant demand. And I was just reading yesterday about Tether Holdings, as in the crypto, the crypto company. They are turning into one of the world's, I don't know if people know about this, but one of the world's largest holders, apart from central banks, of physical gold. They have a huge bunker underneath the Swiss Alps, which basically they hold apparently around about 140 tons, 140 tons of physical gold. Their CEO is basically saying that they are trying to buy 1 or 2 tons per week, and he said for the foreseeable future that is going to be the rate of purchase. So basically, Tether is becoming a major player in the physical bullion market, apart from all the central banks. So the point I'm trying to make is that you have continuous central bank buying. You have retail interest in the West. You have companies like Tether who are buying central gold. Sorry, sort of physical gold. You also have asset allocators and fund managers and asset managers who are saying, hey, we need to have an extra percent or two in our asset allocations. The gold market is relatively small in terms of market cap. So if you have, let's say, for example, global developed markets, US, Asia, China, um, Europe, the asset managers just buying an extra, maybe let's say percent allocation to gold, that is going to provide a constant bid up for gold. And then finally, let's just keep in mind, I was looking at something like the Shanghai gold warrants, which is kind of like, sort of a sort of an option on gold, absolutely going, well, parabolic or very, very strong. You see here in the black line, the gold price in yuan, the Chinese renminbi, is going higher. The point is that Shanghai, the gold exchange, is the biggest in the world outside of London and New York, but it's getting very, very close. The central government there is encouraging that. So the Communist Party is encouraging that. So Shanghai is becoming a major a global hub for physical gold, and Chinese retail, who have been absolutely destroyed all of the real estate market. It's difficult for them to invest in crypto, as I've said many times. Any extra cash and liquidity is going into gold, which in China, of course, has a 5,000-year history. There's a lot of culturally, it's very comfortable for the Chinese to be buying gold and silver, but especially gold. So my point being is that for sure we can all look at the chart and see that these things are overextended, but there are real reasons for a continuing bid. So really, it's a question of waiting for shakeouts like we had 2 or 3 days ago, waiting for Fibonacci retracements. And if the U.S. president comes on the wires and basically says that he's okay, the US dollar is kind of like a yo-yo, and I don't mind where it is, it'll find its own level. That's a green light for gold as well. Now, obviously, silver. I talked about the margin increases in at the COMEX exchange now up to 11% of notional. So when you think about it, if we've got you just take the notional value, 11%, that's getting very expensive, certainly for retail, even some institutions. And in China as well, they've just increased the margin overnight. So the point is that silver having a little bit of a pullback, but it's still doing pretty well. If you look at the other precious metals, let's say platinum, just coming off the boil a little bit, and palladium. So definitely maybe a bit of froth is coming out of the market. Could we see a pullback? Yeah. And we'll see what our friend Jerome Powell has to say. Finally, let's have a look at copper here. You see that copper is, just pulling back just a little bit. So I'll leave it there, guys. Actually, just quickly on the BTC. BTC, hasn't really joined the party. Although, as I was pointing out a lot of time, that very key level here, the 86,700, you see that very key level here, does seem to have held a little bit. And finally, BTC seems to be getting the memo about sort of the weakening US dollar as the preferred position potentially of the US administration. In terms of the equities, we had very strong earnings in the tech sector from not only ASML over in Holland. That's very positive for tech in general, but we also had SK Hynix over in Korea, which is doing very well. So, pretty positive earnings for sort of tech here. And you can see the Nasdaq ripping higher. I guess maybe it wants to retest up here. ES also doing pretty well. You can see the ES doing pretty well, is testing its highs. Not so strong on the Russell. But still, trading quite strongly. And of course, obviously, just to finish off, we have the earnings, the big ones after the market today. We have, just so we can all remind ourselves, where do I have that? I think I had that up here. Yeah, let's have a look here. So we had ASML, which was very, very strong this morning. So after the market, we have Microsoft, Meta, and Tesla. Um, Yes, so that will obviously, along with the Fed, determine how things go in overnight and tomorrow. Thanks very much, guys. I'm going to grab some breakfast and I'll be back with the FOMC preview probably in an hour and a half, something like that. Have a great trading day. Let's keep an eye on the dollar. And let's see as well if people like a Treasury Secretary Bessent tries to talk up the dollar strength and says, no, 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 Trump sort of slightly got it wrong. We love a strong US dollar. That could be something which just gives the US dollar going into the FOMC a little bit of a boost. And as I say, if we get strong tech earnings, and we get strong employment data tomorrow with a semi-hawkish sort of Fed. Who knows? Maybe the dollar can recover a little bit over the next few days, and we'll see what happens. Okay, thanks very much. Have a great morning. Thank you.